Give the heading currency options. Heading currency options. Please. Shh. Currency options. Okay. We have a chapter, page number 11, chapter number 5, called as application of derivatives. Just I am saying what we are discussing in, what is the milestone, okay. Application of derivatives. We have a chapter. Taken that page or not? Page number 111, application of derivatives. Please. Options, futures are the two derivative instruments. We have two separate chapters for them. Not? In application of derivative, I have three segments. How many segments? Three segments. First segment is currency options. Second segment is what? Currency futures. These two deals with the foreign currency options and futures. Third segment is the real option, in which already we discussed the valuation of a vacant land. We have an oil reserve valuation and then a patent valuation also to be discussed. I'll discuss at the end of the derivative chapter, not now, too early to discuss it. Okay. These are the three segments. We'll now complete the segment number 1, called as what? Currency option. In another 3 classes, we'll be completing the chapter futures. And immediately go and say, settle one, the segment number 2, currency futures. And only 2 more sums will be left in the chapter. What I try to say is, by the time I complete options and futures, this chapter also 90% almost gets what? Completed. We need not count them as a separate chapter. Everybody following or not? So now, in this I want to discuss about the first area called as what? Currency options. Okay, now. Long back, beginning of the batch, we started with a chapter called as International Financial Management. Remember or not? In my opinion, that is the most simple chapter. After seeing portfolio, after seeing even bond valuation, etc., that chapter is more simple as what? IFM and also capital budgeting. Right or not? No. But you might have forgotten or remember, I just have a small summary of the link to this particular area and then proceed. Now, tell me, you are having a foreign currency receivable or foreign currency payable. Say, suppose you have to receive you have to pay $1 lakh. You have to pay what? $1 lakh. The important machinery, we have to pay $1 lakh after 1 year. Tell me, is there a risk? No risk. What is a risk? If I have to pay $1 lakh today, I can pay 62 rupees or something, and by dollar how much to pay? 62 lakhs I can spend for my purchase. So no. After 1 year, I don't know what will be the dollar price. It is not, because the dollar price may increase or it may what? Decrease. I have an uncertainty in my cash flow due to the exchange rate fluctuation. Respond, yes or no? I know that my import cost is $1 lakh. I do not know what is my import cost in rupees, because at the end of the first year it can be 70 rupees per dollar. Then the import cost becomes what? 70 lakhs. Can even be 60 rupees per dollar. Can become what? 60 lakhs. Everybody yes or no? So what is going to be the cash flow tomorrow? I don't know today. Hence I'm exposed to a risk called as what? Currency risk. This is the introduction we had in the IFM. Respond. Yes or no? Now, can a company keep its risk exposed? No. Can it have a risk exposure? No. Company would like always to want to negate the risk, remove the uncertainty. For that they go for some strategies called as what? Hedging strategies. They call as what? Hedging strategies. What is the meaning of hedging strategy? Risk reducing strategy. We saw the following hedging strategies. What are the hedging strategies? Forward hedging, money market hedging, leading, lagging, exposure netting, currency options, currency futures, currency swaps are all the 8 famous hedging strategies which we are discussing. Yes or no? In that we have discussed everything except for what? Currency option, currency futures and currency swap. Yes or no? Now, Now we are going to discuss about what? Currency option. Once I complete the next chapter of futures, I'll discuss about what? Currency futures. Currency swap, we have a separate chapter. We have a separate chapter for what? Currency swap. We have a chapter on its own. Respond. Are you following or not? So we'll be completing all these three hedging strategies in another 10 or 15 days when I complete the derivative segment. Everybody following or not? Now, in that we are now going to discuss about what? Currency option. Okay. Now, see. Let us understand with help of a small example, and then we can just start doing the problem in this regard. Nothing great, simple concept only. Now, I am an importer. I am one importer. I have to pay, suppose $1 lakh, payable or receivable or payable after 1 year. After what? 1 year. Spot rate is $1 is equal to, spot rate is $1 is equal to, suppose, rupees 62. $1 is equal to what? Rupees 62. Now, tell me, am I exposed to risk or not? Can I say that the import cost today is 62 lakhs? True or false? Why can't I say it is 62 lakhs? Because I am not going to purchase a dollar today. I am going to purchase after what? 1 year. I am exposed to risk. Yes or no? One simple hedging strategy, tell me what I can do. I can go to what? A forward contract. I can go for a forward contract. Suppose there's a forward which says $1 is equal to rupees 65. Is it how much rupees? 65. Now, what I can do today, I can go to the bank, enter into what? Forward contract, where I agree to buy from the bank, how many dollars? $1 lakh at what rupee? 65. The 65 is price decided today, what? Tomorrow, what? Today. For today's transaction or tomorrow transaction? Tomorrow transaction. Is the price decided today for a transaction take place what? Tomorrow. This is what we call as a forward cover. Yes or no? At the end of the first year, suppose the dollar is trading at 68 rupees. What I will do? Pay 65 and purchase the $1 lakh. Suppose the dollar is trading at 60 rupees. What I will do? Again pay what? 65 and purchase $1 lakh. Both me and bank, both are locked to a rate called as what? A forward rate. Respond yes or no? No. Next. Instead of going for a forward, as an import, I go for an option or not? What option? What option? Currency option. That's discussing. Okay. That's okay answer. Okay. What option? Yeah. Call option or put option? Why call option? After 1 year, I have to buy foreign currency. I have to what? Buy foreign currency. I want a guaranteed selling price, a guaranteed purchase price, a guaranteed purchase price. I want to have a right to buy, a right to sell, a right to buy. So I go for what option here? Call option on the dollar. I have what? A dollar call option. Okay. Now, options are all traded in stock exchange. Currency option traded in what? Stock exchange. Now you can go to the NSE website. We have what? Dollar to rupee options quoted for different strike prices. Are you following? We can go. That is 4 currencies are traded in our NSE. Namely the dollar, the euro, the pound and then yen. These 4 are what? Traded in the NSE. The most popularly traded currency is what? The dollars only. So how the shares are traded in the stock market? A share option, that is TCS option is traded in what? Stock market. TCS futures trading in what? Stock market. Same way, currency options and futures also traded in what? The stock exchange only. They have a separate section for the currency options. Everybody following? Okay, can I proceed further? Now, next step. I have to go for what option? Call option. Call option is having a strike price of $1 is equal to rupee 65. For example, $1 is equal to rupee 65. Tell me, what does it mean? After 1 year, I have a right to buy $1 at how much rupees? 65 rupees. How much rupees? 65 rupees. Okay. Now, forward also gives you that is right to buy at what? 65. Option also gives you at what? 65. Both gives a guaranteed 65 price. Yes, what is the difference? Forward cannot be lapsed. Option can be what? Lapsed. If the actual future spot price is 63 mean, still I have to pay bank what? 65 to buy the dollar. Yes or no? But in this case, it becomes 63 means what I can do? Allow it to lapse and then go for what? Option. Now tell me which is attractive? Forward or option? You have to go for forward option or option. Why is it option? Because both forward and option gives me a guaranteed 65 purchase price. But in option, I can even pay what? Less than 65. The FSP is going to be downside. Yes or no? So you always go for a forward option. Then why there should be a forward? If you always want to go for option, there should be no forward now. Why should you go for forward? Option has a disadvantage. To buy this option, you have to pay a premium. Forward, no need to pay any premium. Don't say forward premium. That's different. Yeah, that premium means spot price more than that is FSP more than what spot price. That is not a premium speaking about. I have to pay a price for the option now. Do you pay any price to a bank for buying a forward? No. Forward is not buying. Forward is not what they are buying. Forward is binding both parties. A contract sign. Yes or no? Right is bought here. For getting this right, I have to pay what? A price. Called as what? Option value or option premium. That premium is absent for what? A forward contract. Yes or no? No. Option is costly because it involves a cost. It involves what? Cost. To get this right to buy at 65, I should pay the option right as some money. Yes or no? But for the bank to enter into a 65 rupees transaction, I need not pay bank what? Any money. Yes or no? Don't ask that bank charges a margin transaction cost and all. We always ignore what? Transaction cost. Therefore, in any case, even option buying will be having some margin to be paid as brokerage. Respond, yes or no? In that case, I am speaking only about the real cost of the asset. Should I buy the option? Yes. Should I buy the forward? No. Forward is not bought. It is a contract entered into the both the parties. Respond, yes or no? Tell me, what is the advantage of option? Advantage of option is what? Lapse. What is the advantage of forward? No premium. Then what is going to be what? No premium to be paid. This advantage of option and then forward. Okay. Now, always, generally we buy option to exercise. We buy option to what? Exercise. Here you should understand that if I want to go and buy an option rather than forward, why you go for an option? Because it has got a chance of what? Lapsing. For the lapsing only I pay a premium. Otherwise, I need not pay a premium. I rather go into what? Forward. Everybody understanding what I am saying or not? Since it gives me an option to what? Lapse, it avoids me in losing money. That is why I am just going for what? An option contract. Otherwise, option is same as what? A forward only. Everybody up to this, are you following? So, this is regarding the forward versus option. Okay. Now, above that, we will be discussing two problems. Forward versus call option. Forward versus what? Put option. Just for example, tell me who will go for put option? Payable exposure or receivable exposure? Receivable. If I am going to receive dollar in future, I have to receive and then what? Sell dollar. I want the right to sell. I go for what option? Put option. Now tell me, who will go for call option for foreign currency? Payable exposure. Payable exposure go for what? Call option. Who goes for put option? Receivable exposure goes for the put option. Option involves what? Premium. But has a what is the advantage of lapsing? Forward does not involve premium. But disadvantage is I cannot lapse. The situation is favorable to me. Everybody is so no. This is regarding the forward versus option. Let's have a brief notes and start doing two problems regarding forward versus option indifference point. Okay, give the heading. Forward versus currency option. Forward versus currency option. Forward versus currency option. Point number 1. A person who is having a foreign currency payable. A person who is having foreign currency payable on a future date. A person who is having foreign currency payable on a future date is exposed to the risk of exchange rate fluctuation. Is exposed to the risk of exchange rate fluctuation. Is exposed to the risk of exchange rate fluctuation. Point number 2. To cover his risk, he has two choices. We have 8 strategies. I am only speaking about 2 now. Okay, to cover his risk, he has 2 choices. Branch it into 2. Forward cover. First branch is what? Forward cover. Tell me what is second branch? What option? Call option. Forward cover. Second branch is call option. Forward cover. Second branch is call option. Forward cover, put that down your mark and write. He agrees with an exchange rate. He agrees with an exchange rate. He agrees with an exchange rate which is binding on. He agrees with an exchange rate which is binding on. Which is binding on what? Both the parties. He agrees with an exchange rate which is binding on both the parties. Bank also has to honor, I also have to honor. Yes or no? He agrees with an exchange rate which is binding on both the parties. Second branch, call option right. He gets the right to buy. He gets the right to buy. He is only having what? Right. He gets right to buy. He gets right to buy the foreign currency. He gets right to buy the foreign currency. He gets right to buy the foreign currency at an agreed what price? Strike price. He gets right to buy the foreign currency at an agreed strike price. At an agreed strike price. Everybody able to understand the difference or not? Next. Point number 2 or 3? 3. The call option is obviously more beneficial because if the FSP or the foreign currency, future spot price of the foreign currency, because if the FSP or the foreign currency drops, he can lapse the call. And buy the currency. He can lapse the call and buy the currency in the open market. He can lapse the call and buy the currency in the open market at what? Lower FSP. At lower FSP. So now we said which is beneficial option. Point number 3 or 4? 4. However, to get this option, we have to pay a price called. We have to pay a price called as what? Option premium. To get this option, we have to pay a price called option premium. Which is not there in case of what? Forward contract. Last point. Point number 4 or 5? Point number 5. A person having receivable exposure, will select call or put option or put option. The person having receivable exposure will select put option. Will select put option. With this, we have completed the brief introduction to the area called as what? Currency options. Can I start doing the problems in this regard or not? No, please. Now, question number 1, I will do it later after completing the other sum. Let's start with question number 2, please. Question number 2. Stop talking, please. Shh. At German firms, page number 112, question number 2, under currency option. I am keeping the pen. Seen the problem or not? Located, discovered. A German firm buys a call on $10 lakhs with a strike price of $1 is equal to 1.6 Jewish mark. After a long time we are reading currencies. Now, comfortable? And premium of Jewish mark $1.03. Interest opportunity cost is 6% per annum. Maturity is 180 days. What is the break-even maturity spot rate beyond which the firm makes a net gain? Suppose the 6 months forward rate at the time of option was bought for $1 is equal to 1.62 Jewish mark. What is the range of maturity spot for which option would prove to be better than forward cover? For what range of values will the forward cover be better? That's a question which is being asked. Okay, I'll give you 2 minutes time. Please put the mind into it. Start reading the question. Nothing is new to you. Nothing needs to be thought. You can answer the question on your own itself. Okay, please read the question before you start with the solution. Put an effort to read the question carefully. Shall I proceed? Please. Answer my question one by one. Which is the home currency? Which is the foreign currency? Which is the home currency? Tunga. There is a home currency. Jewish mark is the home currency. Which is a foreign currency? Dollar is a foreign currency. German firm is the, so marks is the home currency and dollar is the foreign currency. This German firm is having a payable exposure or receivable exposure? Payable. It has to pay how many dollars? $10 lakh. Today or later? Later. After how many months? How many months here? After 180 days. That means what? 6 months. It has to pay after 6 months. Okay. Now, it is worried about increase in dollar price or decrease in dollar price. It is worried about increase or decrease? Increase. If the dollar price increases, they have to pay more Jewish mark to buy the same dollar. Yes or no? So they are worried about the increase in dollar price. So they want to have a guaranteed purchase price. So then they went for what option? Call option. What is the call option strike price? $1 is equal to 1.6. Tell me, what is the meaning of $1 is equal to 1.6 Jewish mark? I can buy $1 after 6 months. And how much Jewish mark? 1.6 Jewish mark. This is decided tomorrow or today, today itself. Suppose $1 on that day becomes 1.68. What I will do? Exercise the option and buy at what? 1.60 Jewish mark. Yes or no? Suppose on that date it is going to be 1.48. What I will do? Allow the option to last and buy the dollar in the open market at 1.48 Jewish mark. Everybody, are you found out what I am saying? A dollar is like a share. Dollar is like what? A share. And Jewish mark is like a price for the share. Everybody understanding it? Enough for it or not? No. Okay. Now, what is the premium I have to pay for this option? For $1 option, the underlying asset is what? $1. For a $1 underlying asset option, I have to pay how much premium? 0.03 Jewish mark. Don't get confused. This is not a price for a dollar. Don't think that $1 is what? 0.03 do is smart. It is not a price for a dollar. It is a price for what? A dollar option. It is a price for what? Dollar option. It's different. A price for a dollar is different. The price for a dollar option is what? Different. The price for a dollar is the actual spot price of the dollar. It's or no? This is the price for what? A dollar option. $1 option is having a premium. How much here? 0.03 do is smart is the meaning. Everybody yes or no? No. Say, long ago, just 10 days back, we discussed break-even FSP. Yes, what is break-even FSP of a call option? Strike price plus premium. Till date, so many people are asking doubt about this. Okay, I am just very much upset. Very simple. Yeah. Once again, I tell you, break-even FSP is what? Strike price plus premium. I'll explain one last time, then you can understand it. Okay, see, what happens is, I am going to buy an asset after 6 months. Forget dollar. I'm going to buy a share after what? 6 months. I am buying the share at what price? Strike price. This is an inflow, outflow. To get this right to buy at strike price, I also pay what? Premium. Inflow, outflow. Now, these are the two money I am spending to buy the share. Yes or no? To buy a share, I am spending what? Strike price. I also spend what? Premium. This is a guaranteed buying price. This is a premium paid to get this one. Guarantee. So what is my total cost here? Strike plus price premium. Okay. This cost will be recovered by selling the share or not? I sell the share to what? FSP. If the FSP is equal to what? Strike price plus premium. It is called as what? Break-even FSP because my payoff is zero. Yes or no? The FSP is more means I pay strike price plus premium, I get what? More money, I will be making profit. So no, if the FSP is what? Less, my FSP is not enough to recover what? The strike price paid plus premium. This is the logic for a strike price plus premium. Everybody understood that? Yes, now, those who understood, raise your hand behind them. I should not ask this question now. Have you understood or not? Now. Those who not understood, don't hesitate. One last time I will explain also if you want. Raise your hand. Okay, can I proceed or not? See, tell me, what is the break-even FSP for put? Everybody tell me. Strike price minus premium. Very simple, yeah? Now, put option gives me a right to sell at what? Strike price. The strike price is inflow, outflow, inflow. To get the strike price, I pay what? Premium. What is premium? Outflow. I can exercise only when I buy the share or not. I buy the share at what? FSP. How much FSP can maximum pay? I can maximum pay FSP is equal to what? Strike price minus premium. Otherwise, the FSP is an outflow. I'm going to buy at what? FSP. FSP is an outflow. This FSP outflow and the premium outflow both together should be recorded by my what? Strike price. How much I can pay as a maximum FSP? This strike price minus premium. Beyond that, what happens? I'll be suffering a loss. Everybody, are you follow what I'm saying? This is for put option, right or not? So put option, the strike price is inflow and the premium is what? Outflow. My FSP is also what? Outflow. I buy at FSP the share. I already bought the option at what? Premium. These two costs should be required through what? Strike price. So how much again? Maximum effort for the FSP? It is strike price minus premium is a logic. Enough right or not? No. So tell me, what is break-even FSP for call option? Strike price plus premium. For put option, strike price minus premium. Again revised. Yes or no? No. Now, all those sums we did because the question did not give you any interest rate. In these problems, interest rates given or not? Yes. They give me an interest rate in the problem of how much percent? 6% and so on. When interest rate is given, question has a time value. My question is, can I add strike price plus premium? Why no? Strike price is going to be paid after 6 months. Premium is paid what? Upfront. And it is the price paid to buy the option is yes or no? The premium is the amount paid today. The strike price is going to be amount paid what? After 6 months. Can these two numbers be added or cannot be? Cannot be. Either bring the strike price to what? Today's value or take premium to what? Tomorrow's value. My calculation is what? Break even FSP. FSP is tomorrow money or today money or tomorrow money. So take the premium to what? Tomorrow. So tell me what the formula? Strike price plus future value of premium. Yes or no? What is a break-even FSP? Strike price plus what? Future value of premium gives you the break-even FSP. Point number one. Yes or no? No. Second case, tell me what the formula? Strike price minus future value of premium. Simply strike price plus premium only, when no time value is given in the question. If the exam question gives you a time value of money also into the picture, it should be what? Strike price plus future value of premium, or strike price minus present value of premium. Should be understood. Everybody, yes or no? Can I proceed above? Now, let's come to the problem now. See. I am going to now answer the part A of the question. Part B brings forward into picture. There is going to be next question separately. Let's answer what? Part A. What is part A question? What is the break-even maturity spot rate beyond which the firm makes what? Net gain. Very simple. See. I have a right to buy the dollar at what price? 1.60. If the FSP increases, I'll be happy or not? Yes. Because suppose on the 6th month, the dollar is trading at 1.8. What is the meaning? I have a right to buy at 1.6. A dollar worth what? 1.8. I'll be very happy, too happy, yes or no? No. So when FSP increases, my payoff is positive, yes or no? When FSP decreases, my payoff is what? Negative. At some FSP, I'll be having what? Zero payoff. That is called as break-even FSP, yes or no? Tell me the formula of the break-even FSP. Strike price plus future value of premium. What is strike price? 1.6, do it small. Can I add 0.03? No. I have to compound 0.03 for how many months? 6 months. Normally, derivative contrast will be compounding using what compounding? Continuous compounding. In examination alone, they always bungle. Sometimes they do continuous compounding, sometimes they do what? Normal compounding. I'll do a simple trick, I'll tell you. Now, if they want you to use continuous compounding, they give you E value. If the question paper E E means not fly, it is having what? E means, E computation given means. So then they ask you to do what? A continuous compounding you have to follow. So not. If the question paper does not give you what? The E value, then I have to go for what? Normal compounding. Simple technique can just follow in the examination. Yes or no? No. Because sometimes I give, sometimes I don't give, and there is no consistency. So this is a trick in which you have to apply to understand how the solution can be done. Are you following that? But in our classroom, derivative itself means what? I'll always use a continuous compounding itself, because this currency options all has got mark to margin account. What is it we'll learn today possibly, or what in the next class? Can I say? At that time you know why I'm doing continuous compounding for a derivative contracts. Are you following what I'm saying? There's a logic for doing a continuous compounding. Why it is? We can see when you know how the cash flow comes for an option as well as a future. Can I say or not? Now. Always derivative contracts, exchange traded, I'll be always using what? Continuous compounding, more logical. Can I proceed? Now, come back to discussion. Now, I have to calculate first what? Future value of premium, and then add it to the strike price. Can I proceed? Now. Okay, let's do it together. Question number, what is question number? 2. So you know which chapter we are doing now? The chapter name is what? Application of derivative. Then you can also note down the page number just to have a link. Okay, question number 2. Okay, facts. What is the exposure? What is the exposure? $1 lakh payable. Please. $10 lakh payable. So exposure is $10 lakh payable. $10 lakh payable. Call strike price. Now I am buying a call option having a strike price of what? 1.6 Deutschmark. That means $1 can be purchased at 1.6 Deutschmark. Call strike price is 1.6 Deutschmark. What call? Dollar call is the meaning. Understood? Next. Call premium. The premium for $1 option is how much here? Deutschmark 0.03. Deutschmark 0.03. Term of the option, I get this right to buy after how many months? 6 months. Term of the option is 180 days, or also write as 6 months. Not an issue. Interest rate. What is the interest rate? 6% per annum. Interest rate 6% per annum. Finish writing up? No. Write down. Step 1. Future value of premium. Future value of premium. Underline that. Future value of premium is equal to 0.03 into e power TR. Yes or no? e power, what is time? 6 by 12 into 0.06. We'll do it together. All of you apply your mind and write 0.03 into e power 6 by 12 into 0.06 is equal to 0.03 into 0.03 into e power 0.03. Yes or no? 0.03 into e power 0.03 is equal to 0.03 into what is e power 0.03? 1.0305. Correct? 1.03045 or 05. By this time it should be by hearted. Yes or no? 1.0305. Multiply and tell me what is 0.03 into 1.0305? 0.0309 is equal to 0.0309. Future value of premium is 0.0309. Step 1 over. Yes or no? No. Step 2. Calculation of break-even FSP. Calculation of break-even FSP. Calculation of break-even FSP. Write down. Break-even FSP is the FSP at which. Break-even FSP is the FSP at which the payoff to the holder is. Break-even FSP is the FSP at which the payoff to the holder is what? 0. The payoff to the holder is 0. Earlier we saw that for a call option, break-even FSP is equal to, write the formula, BEFSP is equal to, break-even FSP is equal to what? Strike price plus premium. Strike price plus premium. Strike price plus premium. Please continue. When we have time value of money, we cannot add these two numbers per se. When we have time value of money, we cannot add these two numbers per se. We cannot add these two numbers per se. Because strike price happens after 6 months. Because strike price happens after 6 months and premium paid upfront. Strike price happens after 6 months and premium paid upfront. Strike price happens after 6 months and premium paid upfront. Everybody following or not? Write down next line. Break-even FSP is equal to what? Strike price plus strike price plus what? Future value of premium. Strike price plus future value of premium. Strike price plus future value of premium, which is equal to, substitute what plus what? 1.62 mark plus 1.62 mark plus what? 0.0309 Dewey mark. 1.6 Dewey mark plus 0.0309 Dewey mark. Everybody understanding or not? Is equal to how much? 1.6309 Dewey mark. Is equal to 1.6309 Dewey mark. 1.6309 Dewey mark. Everybody answer me. Are you following what I am saying? Now, in center right situation. I will tell, you should answer me. Okay, center right what? Situation. Branch it into 3. First branch. FSP greater than 1.6309. First branch. FSP greater than 1.6309. FSP greater than 1.6309. Stop writing, please. Tell me. The dollar after 6 months, please. The dollar after 6 months is trading at 1.67. Let us take what? 1.67 Dewey mark. Tell me, everybody, will you exercise option or not? Yes. I have a right to buy at what? 1.6. Something what? 1.67. I'll exercise. And what is the value of the call? 0.07. Yes or no? In that, how much is the future order premium to be paid? 0.0309. The balance is the amount that I am earning as payoff. Yes or no? In that case, tell me, the option payoff will be positive or negative or zero or positive. Write down, put the down back and write. The option payoff will be positive. The option payoff will be positive. This is what we did so many times in the basics to option. Yes or no? The option payoff will be positive. When the FSP is more, option payoff will be positive. Second branch, FSP is equal to 1.6309. FSP is equal to 1.6309. FSP is equal to 1.6309. Tell me, the option payoff is positive or negative or zero or zero. The option payoff is 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 zero. Don't toss it. Don't write and tell me. Listen and tell me. When you exercise the option, lapse. Exercise or lapse? Exercise. The option is what? Exercisable. I have a right to buy at 1.6. Do is small. A dollar worth what? 1.6309. I exercise the option. Buy at 1.6. I can select what? 1.6309. What is the profit for me? 0.0309. Be used entirely to recover what? The premium amount at future value. Yes or no? In that case, what stays behind is what? Zero. Hence, we can break even FSP. Yes or no? Now, come to the third. FSP less than 1.6309. FSP less than 1.6309. Tell me, what happens here? Gives negative payoff. Option gives negative payoff. The option gives negative payoff. The option gives negative payoff. Now, what is the maximum loss for me? The premium. And the maximum loss is what? Premium paid. And the maximum loss is the premium paid. When I say premium, I mean also the interest along with the future value. Okay? The maximum loss is premium paid. Tell me, if the option is, if the dollar is trading after 6 months at 1.40, what I will do? Exercise or lapse? What I will do here? Lapse. Allow the option to what? Lapse. In that case, what is my loss? 0.0309, the premium paid. Respond yes or no. Either break even FSP for a call option. So now we viewed the call option alone. And what is the range at which I will gain? Range at which I will be losing, and I will make no gain, no loss. This is a simple basic option problem. Everybody yes or no? No. Those understood, raise your hand. Can I proceed on? No. Next. Next, I am going to discuss about forward versus option. I am going to discuss about what? Forward versus option. That is going to be discussed in the second part of the question. Please. This we are going to discuss something called as indifference point. Something called as what? Indifference point in forward versus option. Can you start or not? Now, see. Okay. If we look at the question part B, how I have a call option. Please stop talking. How I have a call option having a strike price, how much do I mark? 1.60. There is also a forward that is available for how much? Yeah, $1 is equal to 1.62. Can you approve that? No. My question is, option itself is having only what? 1.60 strike price. Forward is having what? A rate of 1.62. Will anybody go for a forward? Question arises. No. Don't think that option is costing 1.60. Option cost me 1.6309 because I not only have to pay a strike price of 1.60, I have to pay free how much? 0.0309. Respond yes or no. So whenever you see the option, don't compare the strike price with what? The forward rate. It is misleading because to get that strike price on hand, I have to pay what? Some premium. Respond yes or no. In that case, the real cost of option is what? 1.6309. The forward is only what? 1.62. I say forward is good because it is costing me only 1.62 per dollar after 6 months. Option cost me what? 1.6309. Even if I exercise option, I will be getting what? 1.6309 outflow. Forward has got only what? 1.62. Don't go for option, go for forward. Am I right or wrong? Understand my question or not? No. See, once again, here is only the way of understanding. It's simple, commonsensical things only, but understand proper sense. Okay, I'll start once again. Now, $1 after 6 months, I can buy using forward contract or option contract. Two options for me, yes or no? If I go for a forward contract, what is the cost of $1? 1.62. Accept that. We go for option contract. What's the cost of $1? Don't say 1.60. Say as what? 1.6009, because I not only have to pay the strike price, I also have to pay what? The premium. So the cost of the dollar under the option is what? 1.6309. And what is what? 1.62. Which is a cheaper way to buy the dollar? Forward option. Forward seems to be what? Cheaper. Even if I suppose FSP is 1.7, how much? 1.7. $1 is equal to 1.7 FSP. If I exercise option, what I have to pay? 1.6309. If I exercise forward, what I have to pay? 1.62. Forward is cheaper than option at higher FSPs. Yes or no? Then why should I have an option? Option based. True or false? Because suppose it's going to be what? 1.40. Suppose it's going to be what? 1.40 and so on. Everybody yes or no? In that case, the forward still have to pay 1.62. But in option, I can allow the option to what? Lag. I pay 1.40. The premium much 0.0309. You pay 1.4309. Yes or no? Option what the benefit comes not when the FSP is increasing. The FSP is what? Decreasing. When I compare with the forward. Yes or no? The advantage of option is not the option to exercise. Advantage is what? Sometimes lapsing itself gives you what? An advantage. Everybody yes or no? So it's an option to lapse for me. That makes the option attractive. Yes or no? That means at some FSP, forward option should be equal. And above the FSP, option should be, so forward should be what? Better. And below option should be what? Better. The call option works for me against forward. Only the FSP drops. Yes or no? When the FSP is 1.2, which is better? Option. $1 is equal to 1.2 do ISMA, which is better? Option. $1 is equal to 1.4 do ISMA, which is better? Option. $1 is equal to 1.5 do ISMA, which is better? Option. $1 is equal to 1.6 do ISMA, which is better? They have to check. 1.61 is better here. Option may be much more worse than what? Forward. Yes or no? In that case, there's an indifference point between forward and option. Below indifference point, option is better. Above indifference point, what? Forward is better. One should be understanding it. In by yes or no? Forward versus call option, indifference point. Tell me yes or no? In this discussion, why should I hold an option? Because it gives me a chance to lapse. Always you should think negative also maybe what? Sometimes beneficial. It always gives me a chance to lapse. That makes option better than forward. Can I proceed or not? No. Let's go for the discussion now. I'll do it and then I'll give you time to copy it. This has been already discussed. Okay, please. Okay. See, I want to be indifferent. I want to be what? Indifferent. Forward amount certain. It is only amount. It does not depend upon what? FSP. Does option depend upon FSP? Yes. When FSP falls, the money will be reducing. Yes or no? Now, what the forward amount I have to pay? If I go for forward cover, always I pay 1.62 do is small to buy a dollar. Is accepted? Yes, sir. Okay. Now, that means for me to be indifferent, the option outflow also should be what? 1.62. Under the option, I should pay maximum how much? 1.62. This entire 1.62, I cannot pay for the dollar because I already paid for what? Option. How much? 0.0309. Yes or no? That means how much I can pay maximum for a dollar here? 1.62 minus what? 0.0309. I can maximum pay how much? 1.5891 price for the dollar. Innappa right or not? That is, for option to be having a same cash flow as forward. Please listening. For the option to have what? Same cash flow as forward. The option total cash flow should be 1.62. Yes or no? In this 1.62, I have already paid what? Premium. How much is 0.0309? What the balance amount that is available in my hand to pay for what? The dollar purchase. 1.5891. This is a maximum I can pay for purchasing the dollar. To pay this, I should exercise the option lapse. If I made to exercise and pay for a dollar, the strike price is 1.60. Yes or no? No. That means for this outflow to happen, I should be having a situation where I should be having the option to want lapse, and the FSP should be what? 1.5891. Yes or no? That means in the foreign currency market, after 6 months, your dollar is trading at 1.5891. Everybody, how much here? 1.5891. If you are an option holder, what you will do? Sorry, allow the option to lapse. Buy the dollar in which market? Open market. At how much do it mark? 1.5891. Already I paid how much for option? 0.0309. What is outflow? 1.62. The same thing I will be having with what? Bank. If I go for forward cover. Yes or no? Suppose the FSP is 1.5890. Next is going to be 1.5890. Tell me, in case of option, I will exercise a lapse or lapse. What is the amount I paid to buy a dollar? 1.5890. What the premium I have paid? 0.0309. What the total outflow? 1.6198. Forward was the outflow? 1.62. Which is better? Option is better. Respond. Yes or no? No. Third case, 1.5892. Suppose dollar is trading at what? 1.5892. Exercise or lapse? I have a right to buy at 1.6. A share worth what? 1.5892. Exercise or lapse? Lapse. What is the outflow? To whom I pay? Outside market. What the premium already paid? 0.0309. What total outflow? 0.6201. Forward 1.62. Which is better? Forward. Respond yes or no? So very simple. Indifference point is what? 1.5891. If I expect the FSP to be 1.5891, I'll be indifferent between what? Option and then forward. If there's a chance that FSP can go below what? 1.5891, it is better to hold an option because it is giving a chance to lapse, buy at a cheaper FSP with premium will be much more lesser than the forward. Above this 1.5892, what happens? I go for the forward contract. This is a forward option indifference point. So I have done this for the sake of understanding. Simply, what is indifference point? Forward rate minus what? Option premium. What is indifference point? Forward rate minus option premium. Now forward rate is the maximum outflow I can afford for buying what? Dollar. It means already I paid for the option amount 0.0309. What the maximum price I can afford next year? That is 1.5891. Forward rate minus what I say? Premium is going to give me the indifference point. Everybody accepting it or not? Now, please copy the solution quickly. Forward versus option. Did you all receive a small sheet here? Yes, that quotation. Yes, when you discuss future, at the end of the chapter, you should be able to read all the quotations. Once you know that, I'll give you another class, option quotation also, how it is traded in the market. You'll be able to understand the options also properly, how it is traded. Finish copying up. Those are absent yesterday's class. Raise your hand. Whether it is my wrong perception or not, I don't know. But every time when I see Sunday class looks house packed, okay, full. Other days, I don't know whether it is my perception, the class look what, less packed. Probably other days 6:15 you're not able to wake up. Sunday 10 o'clock you wake up. Can we go to class or not? Okay, let's go and see what is happening. Okay, they're coming. Those not copy, raise your hand. Please, copy fast. Can I proceed? Write down. FSP, please. Shh. Sorry, in center right, situation. Don't talk. In center right, situation. Branch it into 3. Situation, branch it into 3. First branch, FSP greater than 1.5891. FSP greater than 1.5891. Put that down here and write. Tell me which is better, option or forward? Forward. FSP greater than 1.5891. It is forward. Second branch. FSP is equal to 1.5891. FSP is equal to 1.5891. Tell me the answer, option or forward? Indifferent. Write as what? Indifferent. Less than, FSP less than 1.5891. FSP less than 1.5891. What is the option here? It is option. The choice is option. The choice is option. Okay, now write down. Next. Indifference point for a forward with call option is equal to indifference point for a forward versus call option is equal to indifference point for a forward versus call option is equal to, can tell me the formula? What the formula? Forward rate minus is equal to forward rate minus future value of premium is equal to forward rate minus future value of premium. If the question does not give you the time value of money, simply forward rate minus premium, because you don't know the interest to be compounding. Okay, forward rate minus future value of premium here. Can I proceed or not? Now, with this I complete the solution to question number 2. Can I proceed? Now, same way we will be doing what? Question number 3. Only thing is, it is not a call, it is what? A put option. Can I proceed? Now, take question number 3. Stop talking, please. Shh. No great explanations. Will be straight away going into what? Solutions, because already discussed the issues. Okay. Stop talking, please. A French exporter to UK has 90-day sterling receivable. What is sterling? Pound sterling. Equals what? Pound sterling, or Great Britain pounds. Equals what? Sterling. Okay. Now, because in one of the bad they asked what is the sterling given. Okay, that's what I'm just saying. Nothing wrong. People may not be aware of it. Can I proceed? Please. Shh. A French exporter to UK has 90-day sterling receivable. Shh. He purchases a put option of pound sterling 2,50,000 at a strike price of 1 pound is equal to 8.0550 French francs at a premium of French franc 0.20 per pound. Current spot rate is, that's a mistake, current spot rate is 1 pound is equal to 8.1000 French franc. 90-day forward rate is 1 pound is equal to 8.0750 French franc. Interest opportunity cost for the firm is 9% per annum. Calculate the maximum FFR to pound rate at which at the end of 90 days, below which the firm will make a net gain from the put option. Calculate the range of maturity spot over which option would be better than the forward and vice versa. Is a question. Same question. First part A is break in FSP. Part B is what? Indifference point between forward and option. That's a question. Can you start or not? No. First of all, let us consolidate the fact and then proceed. Tell me, which is a home currency, which is a foreign currency? Answer. Which is a home currency? French franc. Which is a foreign currency? The pound sterling. What is foreign currency? Pound sterling. Next point number 2. This person is having a receivable exposure, payable exposure. Because he is going to receive what? 2,50,000 pounds after 3 months. 250,000 after what? 3 months. A person having receivable exposure will tomorrow buy pound, sell pound, sell pound. He is going to receive pound and then what? Sell it. He wants a guaranteed buying price, selling price, selling price. He will go for a call option, put option, put option. He wants to have a right to sell, yes or not? Now he purchased a put option by paying how much premium? He purchased a put by paying how much premium? 0.20 French franc as premium. So 0.20 FFR per pound means this pound should be understood as what? Pound option, not the pound. So it is, don't think it is not an exchange rate. It is not what? Exchange rate. FFR 0.20 per pound means every pound option is costing you how much premium? 0.20 French franc. Respond yes or no. Now what is strike price? What is strike price here? 8.0550. 8.0550. Okay. Spot price is not required. I'll bring the forward later. Now the first question is what? Find out what? Break even future spot price. Tell me the formula. Put option normally ignore time value of money. What is break even FSP? Strike price minus premium. Now tell me what is break even FSP? Strike price minus future value of premium. Everybody understood or not now? That's the one should go for the calculation. Can you start now? Write down. Right? Facts. Question number 3. Facts. Exposure. Exposure. What is the foreign currency exposure? Tell me the number, the currency and the nature. 2,50,000 pound. It is what? Receivable. 2,50,000 pound receivable. Put strike price. What is strike price of the put option? 1 pound can be purchased. I have a right to buy a pound after 3 months. At what price? I have a right to sell a pound after 3 months. At what price? 8.0550. Put option it is 8.0550. Again to confirm, what is FFR 8.0550? After 3 months, I have a right to sell 1 pound at how much FFR? 8.0550. If the FFR is 9, what I will do? FFR is 9, what I will do? Allow the put to lab. Sell in what market? Open market. FFR is 8, what I will do? Exercise support and sell at what? 8.0550. I think I'll be able to understand or not? No. Next is put premium. To buy a put option, what a premium in French franc here? 0.20. Put premium 0.20. Next. Term. What is the term of the put option? 3 months. 90 days or 3 months. What is the interest rate? 9%. Interest rate is 9%. Can I proceed? Now. Step 1. Can you guess what is step 1? Future value of premium. Step 1. Future value of premium. Wait. Future value of premium is equal to, right, FE for future value in classroom. Future value of premium is equal to, future value of premium is equal to 0.2 into e power, how many years? 3/12 years into 0.09. 0.2 into e power 3/12 into 0.09. I want to do it elaborately. Is equal to 0.20 into 0.20 into e power what? 0.0225. 0.20 into e power 0.0225 into e power 0.0225. 0.20 into e power 0.0225. Yes or no? This is equal to 0.20 into, all of you should have done by this time. 0.20 into what? 1.0228. 1.0228. 0.2 into 1.0228. 1.0228. Is how much here? 0.2045. Is equal to 0.2045. Some number, 4 decimal, don't fight with me, 0.2045 is equal to 0.2045. Is a future value of premium, yes or no? Now, next step. Step 1 or step 2? Step 2. Break even FSP. Break even FSP. Now, I don't want to dictate notes once again. What is break-even FSP? Also say that it should be adjusted for time and happening. All this you already know. Can I straight go for a calculation or not? Right? Break-even FSP is equal to, like the formula, break-even FSP is equal to strike price minus future value of premium. Break-even FSP is equal to strike price minus future value of premium. Strike price minus future value of premium, which is equal to, what is the strike price? 8.0550, 8.0550 minus 0.2045. 8.0550 minus 0.2045 is equal to how much? 7.8505 is equal to 7.8505. Break-even FSP is equal to 7.8505. Now, somehow you done along with me, whether you thought or not, I don't know. Now you think and tell me. Everybody, are you all ready or not? Yes, sir. Good afternoon, friends. Sollupa. Now, if the FSP is higher, I will exercise lapse. Why? It's a put option. If the FSP is lower, what I will do? Exercise. Now, let us say, suppose the FSP is 7.90. FSP is what? 7.90. What I will do? Exercise or lapse? Lapse. And I'll put option to what? Lapse. In that case, I am going to lose a premium. I don't get any pay from the option. Yes or no? No. Suppose the FSP is what? 8. What I will do? What I will be exercising a lapse. Lapse. And it is also more than what? 7.85. FSP is 7.5. What I will do? Exercise. I'll exercise the put option and select what? 8. And so first I'll buy the dollar and buy what? This pound. I buy the pound at what? 7.5. I exercise the put at what? 8.0550. I have a gain. It's more than what? Premium paid. I make a net gain. Enough for it or not? Should I repeat that? I'll repeat once again. Now, please listen. Take the calculator. FSP is 7.5. So, FSP is what? 7.5. What is the meaning of 7.5? After 3 months, a pound is trading in the market at how many French franc? 7.5 French franc. Respond yes or no? You have a right to sell at what? 8.0550. Yeah, pound worth what? 7.5. Will you exercise the right or lapse that? Exercise. What I will do? I buy at 7.5 and sell at what? 8.0550. Tell me the profit. 0.55 is a 0.55 is a profit. Okay. Minus what? 0.2045 gives you what? A net gain. Yes or no? So when the FSP is 7.5, I make a net gain or not? No. Answer me. Suppose the FSP is 7.8505. What is the meaning of that? After 3 months, the pound is trading in the bank at how much rupees? 7.8505. Tell me, will I exercise the put or lapse? Exercise. I'll exercise and sell at what? 8.0550. I buy the pound in bank at 7.8505. Sell to the writer at how much? 8.0550. How much I make as a gain? 0.2045. That exactly covers what? Premium. The payoff is 0. Yes or no? Above this, what happens? I'll be having a negative payoff. Are you following up? Now, write down situation. Branch it into 3. Situation. Branch it into 3. See, normally simple things you may lose focus. What is being done? When you revise like this, the focus is lost. What you should do is, you see the situation, put trial numbers and understand what is happening. You'll be getting the grip back. Are you following up? Now, situation. Branch it into 3. Branch it into 3. First branch. FSP less than 7.5. Sorry, less than 7.8505. FSP less than 7.8505. FSP less than 7.8505. Tell me, what is payoff? Positive payoff. Positive payoff. Is equal to, FSP is equal to 7.8505. FSP is equal to 7.8505. Tell me what it is? 0. Payoff is 0. Payoff is 0. FSP greater than 7.8505. Greater than 7.8505. What the payoff? Negative. The payoff is negative. This is viewing a put option. Yes or no? Now we are going to compare two things. What two things here? Put option with what? A forward sell. Put option with what? A forward sell. Let us do the comparison. Can I proceed now? Look at this. Put option gives me a right to sell after 3 months at how much? 8.0550. Respond yes or no? But the same forward contract gives me an ability to sell how much? 8.0750. I think they are falling out now. So put option gives me right to sell at only what? 8.0550. Forward is much more better, right or not? Tell me, is forward better than put option or can I just like that? No. Because put option has got the ability to what? Lapse when the FSP what? Increases. That I cannot do with what? The forward. In that case, I should go for indifference between what? A forward contract and put option. That's the next issue to be discussed. Now, please, all of you participate. Then I'll give you time to copy. Okay. Same type of columns. First is what? FSP, exercise, inflow. Why inflow? Strike price is a inflow. Then what? Future value, premium. Inflow, outflow, outflow. Then I have what? Net inflow, forward inflow, and then remarks. Can I start or not? Everybody should participate. I want to be first what? I want to be indifferent. For me to be indifferent, the forward cash flow should be equal to what? Put cash flow. Out of that, which is certain? Which is certain? Forward. What happened to FSP? The amount is what? Blocked for both the parties. Or no? Tell me what the forward cash flow? 8.0750. Under forward cover, I will be selling £1 at how much? 8.0750 after 3 months. Yes or no? No. That means put option also should be having an inflow how much? 8.0750. This inflow I should be having after paying premium. Yes or no? Then what's the premium amount? 0.0245. That means my inflow should be more than net inflow, less than net inflow, more than that. What should be the number here? That is, only if I am able to sell my pound at how much? 8.2795. After recovering what? Premium, I will be left with what? 8.0750. It is same as a forward cover. Yes or no? No. In that case, tell me the FSP should be how much? 8.2795. I'll exercise our labs last. I think the strike price is 8.0550. 8.2795 is above that or not? FSP more than strike price, lapse. I need not sell at 8.0550. I sell at what? 8.2795 in the market, and from that I pay what? 0.0245 premium, and we get a net inflow same as what? Forward. Yes or no? No. My answer is, tell me, if the FSP is 8.2794, FSP is what? Less. Which is better? Option or forward? Yosiba. Think, forward or option? First of all, again tell me, what is the strike price? 8.0550. Blank ahadiya, always try to follow meticulously. Should I explain? Those who say yes alone, raise your hand here. No, yes, now okay. At least one yes is okay now. Okay, I'll explain once again. ரொம்ப simple. See. Now, forward contract, I have to pay, I have to receive 8.0750. The question, what is the question? I am going to buy pound tomorrow, sell pound tomorrow, sell pound tomorrow. If I sell pound tomorrow, I have a forward rate, how much? 8.0750. Whatever may be the FSP, I'll sell at what? 8.0750. I'll get an inflow of 8.0750 from forward. Yes or no? For me to be equal to forward and the put option also give me what? 8.0750. If the put should give me this inflow in hand, this is an inflow before premium, after premium, after. What the premium have to pay? 0.2045. Before premium, by selling the pound, how much should be in my hand? 8.2795. I should have 8.2795 French franc in hand from selling what? Pound. Before paying premium. Yes or no? No. This, I cannot sell by exercising option. Why? Because if I exercise option, I'll be getting only strike price of what? 8.0550. But I want how much? 8.2795. That means this situation arises. Only the option is what? Lapsed. I sell in the FSP at how much? 8.2795 for the option to be lapsing. Yes or no? Now, let's think the normal way. Now, in the open market, after how many months? 3 months. The pound is trading in the bank at how much? 8.2795. You are an option holder. Will you exercise a lapse? Because you have a right to sell at what? 8.0550. Pound worth how much? 8.2795. You sell with the right, sell in the open market, sell in the open market and get how much rupees? 8.2795. Already you paid how much premium? 0.2045. What amount in hand? 8.0750. What the forward cash flow? 8.0750. Both are what? Same and be indifferent. Yes or no? FSP 8.2794. Exercise lapse. All of you exercise lapse. Why lapse? I have a right to sell at 8.0550. A pound worth what? 8.2794. Allow it to what? Lapse. I am selling in the open market. How much you pay here? 8.2794. This is what I get for selling the pound. Yes or no? Can I take the entire money home? No. I have paid a premium. How much you pay here? 0.2045. What's the net inflow? 0749. What a forward? 8.0750. Which is better? Forward is better. Yes or no? No. So it is 8.2796. Exercise lapse. Lapse. I have a right to sell at 8.0550. Yes, pound worth what? 8.2796. Don't exercise a right. Lapse. Selling the open market how much? 8.2796. What the premium paid to be recovered? 0.2745. What is the French franc inflow? 8.20751. What the forward inflow? 8.0750. Which is better here? Option is better. Response is or no? No. Tell me, what is indifference point? What is indifference point formula? Forward rate plus premium gives you what? Indifference point. Right or not? This is regarding the option as well as what? The forward contract indifference point. Are you following or not? No. Please copy the slide before I have the last conclusion. Copy this quickly.